Consider two people with the exact same skills and age. One takes a corporate job, the other starts freelancing from a laptop. 5 years later, the freelancer earns $120,000 a year working from home. The employee sits at $58,000, waiting on an annual performance review. To understand that gap, or uncapped income potential, the right choice depends on which operating system fits your specific stage of life. A salary offers a specific stability mechanism. Every 2 weeks, a paycheck hits your account, regardless of whether you personally found a new client or closed a sale. This includes hidden compensation. Health insurance, paid time off, and 401k matches often add $10,000 to $20,000 in value on top of your base pay. Employers also absorb the operational burden. As an employee, you take on zero risk for marketing, accounting, or finding new leads. That safety net has a price. On a $60,000 salary, your employer pays roughly $15,000 in payroll taxes just to keep you on the team. You cost the company $75,000, but you only see $60,000. That difference is money generated by your labor, but captured by the system. A salary is a premium you pay in lost upside, so the company will absorb all the market friction and business risk. Freelancing uses a different earning mechanism, where time is decoupled from compensation. A company graphic designer earns $25 an hour. A freelancer doing the same task charges a $3,000 flat fee for a 10-hour project. That's an effective rate of $300 an hour, a 6 times multiplier for the exact same skill. This multiplier requires constant client acquisition. When a project ends, the revenue stops, creating the risk of zero-income dry months. Rapid freelance wealth comes from structuring compensation around delivered solutions rather than rented time. The first year of freelancing is often financially punishing. This year one squeeze happens as you take on self-employment taxes and out-of-pocket business expenses. A salaried employee takes home roughly $57,000 after taxes and benefits. A year one freelancer might gross $80,000. But after $15,000 in business expenses and $11,000 in self-employment tax, their net take-home drops to $54,000. In year one, the freelancer works harder for less, but the math changes in year 3. An established freelancer grossing $130,000 nets approximately $96,000 after all deductions. At this stage, the freelancer keeps nearly $40,000 more per year than the employee. Freelance wealth is a deferred reward. It materializes only for those who can survive the low-margin reality of the first 12 to 24 months. Use this framework to decide your next move. It begins with one question. Do you have an in-demand, marketable skill? If no, you're an early career learner. Stay in your job. Let a company pay you to learn the fundamentals. If you have skills but face high financial obligations, like a mortgage, corporate stability is currently more valuable than freelance upside. Segment C is the cap-constrained expert. Highly skilled professionals with low immediate risk are prime candidates to reach uncapped earnings. Your path is dictated by the ratio of your marketable skills against your non-negotiable financial obligations. To mitigate the risk of a transition, retain your salaried job while building a client roster on nights and weekends. Only resign when your freelance net income consistently matches or beats your primary salary. Long-term financial freedom builds through a systematic migration from a low-risk environment into a high-upside model once the data proves you are ready.